Good evening, everybody, and welcome to our session for today. So today we'll be looking at how you can be able to spot imbalance in the market as you trade. So market imbalance is a case where you'd have a disproportionately high number of buy volumes happening, which would cause the price to rally within a very short period of time, or have a very significant supply or significant sale volumes happening in the market, thereby causing imbalance. So imbalance in the market structure can be defined as a case where when you compare between bids and asks, or when you compare between buyers and sellers, there is a significant participation from one of the parties. So they can either be very significant participation from buyers or from sellers, thereby causing an inefficient market. So a bullish imbalance has more buyers behind it, and a bearish imbalance is a case where you'd have significant sellers behind it. So it's where you'd have dominance by one kind of traders, thereby causing price to move quite significantly within a short period of time. So it normally manifests through a strong impulsive move, either to the upside or to the downside. And you'd have price action characterized by very long candlesticks, which tend to have very small wicks or no wicks at all. So cases where you'd find the market forming a very long candle with very insignificant wicks or no wicks at all, then those are cases where you'd find imbalance happening. So candles pulling out of an imbalance are overlapped by previous and next candles wicks. So in most cases, you'll find that the candle which had formed prior to that, or the candles that would form past that, or an area where you have an imbalance, those candles would have no wicks. Or if they have wicks, they tend to have very short wicks on both sides of the candle. So if you have a strong impulse move to the downside, it's usually because there is no significant buy orders to fill that supply, which is happening at that time. So we have an example of a chart here below. So this chart basically demonstrates a case where you have a bearish imbalance. So in this case, you'd notice that the shaded region, if you look at the candle where we have highlighted with this shaded region, you'd be able to see that price pulled out of that area with significant momentum. And if you look at that candle, you'd notice that it has very small wicks. And given that those three candles, so if you look at this candle, and this candle, you'd notice that they are very long. So they're signifying that price was making a significant rally, or there was a significant volatility happening during that period. So this is an example where we have an imbalance which are in favor of sellers. So the reason why you'd want to identify such areas is once you have an imbalance in the market, they tend to create a zone, which we would call a point of interest. So within this area, which is shaded, it becomes a point of interest due to the fact that since price was able to pull out of that area quite fast, it so happens that it's a level which you'd have institutions finding a premium price to sell. So once you have identified it, you'd want to use it as a reference point in the future so that once price comes back to tap into that area, there's a possibility that you'd find an opportunity to sell. So like in this case, you'd notice that price would pull downwards, and when it begins to retrace towards the same level, you'd find that price would tap into that level before again it begins to drift away from that level. So that's why it would be of interest to you as a trader to try and identify such levels so that they can give you optimal areas within which you'd want to take a trade from. So when a full-bodied candle with no wicks is overlapping, when a full-bodied candle with no wicks overlapping it is formed, you've identified a clear area of imbalance. If an impulsive move to the upside occurs, it's usually a result of lack of enough sales to absorb the already existing buying pressure. So again here, we have an example of an imbalance which is caused by buyers. So if you look at this chart, you'd be able to see that within this shaded zone, if you look at the genesis of that movement, so within this area, you'd be able to see that price was able to thrust out of this zone quite aggressively. And if you look at those candles, they barely have wicks. And given the fact that those candles are quite long, then it shows that price moved in a volatile fashion to the upside. So again, having marked that zone, that area would be of interest to traders because it shows that the fact that price was able to move out of that zone quite quickly, there's a possibility that once price pulls back towards that area, there are some orders which institutional traders or big banks would have at that level, or there could be pending orders which need to be filled along that zone before price has pushed back to the upside. So in this case, you'd find that after that significant push in price to the upside, once price comes back again here, it's at this point that you'd have any pending orders being filled before price pushes back to the upside with a significant momentum. So what then causes this case of imbalance in the market? So ordinarily, price typically moves in cycles where you'd have sellers selling when they perceive a price to be at a premium. So in most cases, you'd have sellers selling at a premium, and buyers would tend to hunt a bargain price. So buyers buy at a discount, while sellers would sell at a premium price. So imbalance is therefore some form of inefficiency that is caused by big institutions like banks when they involve in aggressive trading activity. So as you have seen, the fact that you'd have price significantly pushing out of such a zone, that aggression signifies that that movement is caused by very heavy volumes in the market. So such volumes are normally caused by large institutions. So those are the institutions that would cause that imbalance in the market. So it often results in impulsive moves and price imbalances or inefficiencies in the market. As a result, this inefficiency has to, at some point, be closed, or the gap that would be caused by that inefficiency, at some point, it's highly likely to be covered up later in the future. So the reason why such imbalances happen, or why such inefficiencies would happen, is due to the fact that the institution would sort of want to, they usually have a targeted price. So what happens is that the end goal is to make profit from a position that they have accumulated at a particular level. So they would cause these inefficiencies with a targeted area of interest, so that once the orders have been filled, they would then push price towards one side. So they build their position, then they take participants that are against their positioning out of the market, what is normally called sweeping liquidity. And the intention is to remove them out of the market before they push price to their intended direction. In some cases, this imbalance is part of large institutions' scheme to generate liquidity in the market. So again, another reason is to ensure that there's liquidity in the market. Therefore, price may seek to fill any imbalance that may be caused before pushing back into the same direction that the price originated from. So if you look at the two extracts of charts, you'd notice that once you have identified an area of imbalance, you'd find that price would first of all push in the opposite direction. Then it would sort of come back to tap into the area of imbalance before it pushes back towards or far away from that zone where you had imbalance. The same case here, you'd have price pushing upwards quite aggressively. Then once price drops back towards that area of imbalance, and once orders have been filled, then you'd have price pushing further up. So we can now jump into the charts and have a look at an example or two. So here we have an example. So if you look at this chart, you'll be able to see that within this zone, you'd have price making a significant bullish rally to the upside. And when you look at this candle, So we have this long green candle. You'd notice that it bears some of the characteristics that we've discussed. So if you look at both sides of that candle, it barely has any wicks on both sides. Then you'd notice that on the left side and on the right side, there are no wicks covering that candle based on the candles that had formed earlier before that long candle. And once you have that significant push, you notice that the candle has formed a gap. So this gap, which is marked by the yellow rectangle, is marking our point of interest. So the essence of marking this area is to be able to know your area of imbalance, or the point at which you'd want to consider taking a buy position. If at all, price would drop back towards this area. So what you'll notice is that you'd have that bullish momentum continuing. Then at some point, once price begins to drop back towards the lower side, it just comes back towards the same area and taps into that zone before accelerating further up. So this is an example of a case where we have an imbalance which is caused by buyers. So within this area, we had a disproportionately significant buying pressure. So the imbalance was caused by buyers in the market. Another example would be a bearish imbalance. So this is an example here. So here, right from this red candle, this long red candle here, you'd find that a price would push quite aggressively to the downside. And if you look at that candle again, it barely has wicks on both sides. Then that aggressive downward momentum would be sustained within the next two candles. And if you look at the first candle, you'd be able to see that looking backwards, there was a gap. So this gap, which is marked by the yellow rectangle, is marking our point of interest, or the level within which we would want to enter sell positions once price reverts back towards that level. So again, you'd have that bearish momentum sustained before price comes back to tap into that area. And once price taps into that area at this point, you'd have any pending orders which were remaining within that point of interest filled before price pushing again downwards by around 200 pips. So basically, that's how you'd be able to spot areas of imbalance or areas of inefficiency on the chart. And you can actually use them together with your other confluences to find opportunities in the market. So basically, that's it. And I hope that would be of use as you continue to trade with us. Otherwise, that brings us to the end of today's session. And I hope to meet you soon this coming Wednesday. So enjoy the rest of your evening.